Good afternoon, everybody. It is June the 17th of 2022, and I am going to give a few comments on the markets, which have been very volatile in the downside direction for the most part this year. And so I just wanted to take a few minutes to update people on some of the things that I'm seeing and share with you some thoughts. I hope you're having a great summer. Very hot here in Texas, and I know in other parts of the nation as well. And boy, summer came really, really fast and really furious. So hopefully people are staying cool. And I sure am thankful for air conditioning. I'll say that. I'm going to share my screen right now. And I'm going to start. Well, we'll just look at how the market did today, this Friday, and pretty strong day in the market. Everybody can see this pretty much in the green day. The exception being the energy sector, which has been the strongest of all sectors this year. And so you can see how quickly things turn. Look at that. Look at that. ExxonMobil down 5 3/4 or so. ConocoPhillips down 8.72. Very big down day for energy stocks, which had been up for quite a while this year. And those companies that had really been struggling this year, especially the technology companies, about a 1 to 2% up day. Microsoft, Apple, Google, Meta up 2%, Amazon 2.6, Tesla. And so today was a real reversal from the trends that we've been seeing. And that's today, Friday. So yesterday, another very big down day, and today, a rebound in the market. So we have high volatility in the markets right now during this period of adjustments upwards in interest rates, when inflation continues to run hot. And of course, geopolitical events like the war in Ukraine show no signs of abating. And we have a congressional hearing going on here in the United States to look at the events of January 6th, which is bringing up in advance of elections, which will take place in November of this year, bringing up additional political realities and political differences here in the United States. So it's kind of a tough period in lots of different ways. This is the way that markets look for the year. These are different indexes that I'm tracking and sorted by year-to-date returns. You can see that this is commodities, up 30% year-to-date. This is 0 to 3 month treasury bonds, or bills really, very slightly positive for the year. Short-term inflation protected bonds down about a little over 1%. Look at these bonds here. Bonds have had a tough year by bond standards, down almost 9% on national municipal bonds, down 10.3% on international investment grade bonds, things like government bonds in Germany and France. This is investment grade US bonds, down 11% for the year. A mix of treasuries, corporates, and asset-backed securities like mortgages. And of course, I think everybody knows that mortgage lending rates have now risen. When they were down around for the 30-year mortgage bond, or for 30-year mortgages have gone from roughly little under 3% to 5.5%, almost 5.75%. So the cost to borrow money to buy a home has gone up enormously, as have almost all interest rates this year. Emerging market stocks down 18% or so. International developed down 19.77. Here is the US market down about 4% to 5% more than international stocks. So while international stocks have not come close to putting up positive numbers, they have moderated losses in US-based stock portfolios. You see the US is down 23.6% on the year. US real estate investment trusts, highly impacted by interest rates, down almost 25%, 24.55. And here at the very bottom is a Bitcoin investment trust. It's not an ETF. Don't worry about that. So this is not an exact proxy for the price of Bitcoin itself, but it's close enough. And you can see that it's been absolutely crushed. Cryptocurrencies, including, of course, Bitcoin, have really been destroyed. New Capital has not invested clients in Bitcoin unless they have specifically requested that we do that. The vast majority of clients have not requested that, and I'm glad they didn't, because it's been a really brutal period for cryptocurrencies. So we have avoided all of this. We have participated strongly in these. We have been very short in bonds, but we haven't been able to escape all of this at all completely. But we've stayed away from this, so that's good. And our portfolios have held up very strongly relative to benchmarks. We've been positioned defensively both in stock specific allocations and value stocks, and we have for quite a while, and have also been positioned in very high grade bonds, investment grade bonds with very strong credit ratings. And so we've been positioned very well for this current downturn. So where are we in this downturn? I'm going to turn to our friends at JP Morgan, and their this is not the one I want. This is the one I want. And they're very helpful slides that they put out now on a daily basis. The JP Morgan Guide to the Market slides are updated on a daily basis. It's really an incredible service that they do and they provide. And this is the progress of the market going back to 1996. And you can see that beginning in 2008, we had this very long stretch leading up to the pandemic, when we had this very sharp drop. And since that very sharp drop in March of 2019, we've had this very steep rise, and this is the recent fall off that we've had here in 2022. So this is where we're at right now. And I'm going to give you a valuation on that here. We are now trading at around 15.8 times forward estimated earnings on the S&P 500. That is a lot better than where we've been recently at the peak of the market here, when things were very expensive. It's looking a lot better for valuations, both in the stock and the bond markets, as I mentioned. In mortgage bonds, if you're a lender to that market, you're now going to get paid 5.5% to 6% for lending your money to 30-year mortgage borrowers, whereas just a matter of months ago, you were only getting 2 3/4, 3% to lend for 30 years to those borrowers. And so, yes, we've seen a decrease in bond values, but I want everybody to recognize that bond prices are a lot more attractive now than they were several months ago. And the same goes for stock prices, which had gotten quite expensive in a number of sectors, especially in the technology sector. And where we are right now is around right here, 15.8 times forward earnings. Now, those forward earnings, we'll see if they hold up those estimates, because there are signs that there is some weakening in business performance. and even some talk about recession, and maybe we get that. When we get recessions, business earnings fall, and so we will have to see. I'm not able to say whether we're going to get a recession. Nobody knows. But for right now, things are priced more favorably. Let me look at a couple of other charts if I can. This is a good one. Very similar to the one that I just looked at. This is the S&P 500 index forward price to earnings ratios. And here is that 15.8 as of June 16th, yesterday. So that's one of the services that JP Morgan is providing with these updates, is that we can get not exactly real time, but pretty close on a daily basis, get readings on valuations in the markets. And look where we were just a matter of months ago, 23 times earnings or so. This is the line right here for 22 times earnings. There it is on the y-axis. And so we've gone from roughly 23 times earnings on the S&P 500 down to 15.8. So that is an enormous drop in the price to earnings multiple, the valuation of the S&P 500. And to the point that the 25-year average is right here, 16.86 is the average valuation on the S&P 500 over the last 25 years, and we are now below that. And so, you know, I want everybody to recognize that the valuation scenario is a lot more positive now than it was several months ago. And you can see that. You can see this really steep drop that we're having in this most recent period here. We're back from that point, and we're getting to much more average historical. Now, we could see lower. There have been lower points here, certainly back here in 2011. This was during the European monetary crisis. And this right here, of course, was the great financial crisis of 2008. So that's really, really cheap. But this right here was a really catastrophic banking event where many of the larger banks in our country were on the verge of bankruptcy. We are not facing that level of distress in financial markets and in companies. It doesn't mean we don't have problems, but I just don't know that we're going to see this level of distress. I certainly hope not. That wasn't any fun whatsoever. And these valuations look a lot better to me and make me more confident in investing client money to the extent that there's any free cash into this type of market than into this type of market that we were seeing recently. Just a little bit more. I don't want to take too much time on this short market note today, but just do want to give you a few highlights. This is what is expected from earnings, and of course, to have a price to earnings ratio, you have to have the denominator, which is the earnings, and so earnings play a critical role in the price to earnings multiple. And we can see that the consensus analyst estimates for earnings going forward in 2022, 2023, 2024 is for upward movement in the earnings of the companies that are in the S&P 500. These are earnings recessions in green. This would have been during the pandemic. And here are some other earnings recessions in 2008, 2009, where earnings fell from the previous peak. And that happens. But the general trend in the line is upwards. And now that we're in an inflationary period, it's going to be critical that companies be able to pass on increases in their costs onto customers. This is a very tricky thing, this inflationary period that we're in. And there's no doubt that we're going to have to work through it. The Fed raised interest rates by 3/4 of short-term interest rates by 3/4 of an interest rate earlier this week. And of course, that's going to have a very direct impact on what people earn on their cash deposits. I think that it is altogether healthy that we should be seeing a reflation of interest rates. I don't think it's been a very normal, and even I don't know that it's really been that healthy of an environment for interest rates to be so low for so long. I accept that it's been needed to bring the economy out of the recession or the depression type conditions that we were beginning to see in 2008. It's gone on a long time, and there are many people who think that the Federal Reserve waited too long to raise interest rates, but here we are. That's where we're at. And we can see here that earnings from dating back to December of 2021, a year and a half ago, we have seen, this is a graph of earnings growth in the S&P 500. It has been moving upwards. So we have seen companies continue to be profitable. And I think most of us know that generally speaking, aside from the inflationary pressure that we have, which is substantial and important, the economy is pretty strong. A lot of people working who want to work, a lot of economic activity, beginning to see quite a lot of infrastructure work being done across the country in different areas, bridges and roads and things like that. In general, the economy is pretty strong. Nevertheless, what we've seen this year is a fall in the blue, the multiple growth of the S&P 500. So as I've shown you, the 22, 23 times earnings that people were willing to pay for a share of the S&P 500 for its earnings has fallen. And but that has not come about because companies are showing any significant weakness in their earnings right now. Now, they may in the future. It may be that the market sees that companies are going to have a problem growing their earnings at the same rate in the future. That may be the case, and that may be what the market is seeing. I have no way to know that because the consensus earnings are still that companies are going to show good, strong earnings growth. But for a variety of reasons, the market has dropped the multiple growth in blue and the multiple growth in the S&P 500 is now minus 30%. So we've gone from the index trading at 23 times earnings to closer to, like I said, 15 times earnings, 15, 16 times earnings. That's a 30% reduction in the multiple growth. So where I want to leave everybody, and so where does that leave us for the year? That means that the multiple growth in the S&P 500 is down 30%. Earnings growth of the companies in the S&P 500 is up 7.3%. When you add these two together, the S&P 500 price return, the return of the index, what you see in your portfolio on a daily basis is minus 23%. So that's where I want to leave it today. I think that the big picture here is that interest rates have risen. The multiples that people are willing to pay and the prices that people are willing to pay, investors are willing to pay for bonds and for stocks has come down. The earnings of companies is still good and earnings growth is good. It may slow down. It may even turn negative if we get a recession. There are predictions of a recession. But by and large, I, as a professional advisor and investor, am happier investing clients into today's market than I was, say, in January's market. So I wanted to leave everybody with that and wish everyone a very, very good weekend. If you have any questions, feel free to send me an email or give me a call. I'll be happy to receive either. And as always, we stand ready to help you with whatever you may need and that we are able to help with. I would also just additionally say that if you feel like you want to test or retest your risk tolerance and you feel that the recent downward movement in markets and in your portfolio value is concerning enough that you want to take another reading on your risk tolerance, we are happy to do that. We can do that through Zoom. And it may be an exercise that's valuable and tells us that you're feeling differently about risk than you were when the last time we took the diagnostic was. So feel free to let us know if that's of interest. Otherwise, have a great weekend, and I will look forward to coming to you again in the days ahead. I expect we'll do more of these little shorts and keep you up to date on markets. Thanks. Take care.